Let me tell you the exact moment my entire trading career changed. I was trading manually, staring at my charts, confident in the direction, and right before the move happened, I'd get stopped out. Every single time. Price would literally take me out by one pip and it'd go in the intended direction that I wanted it to go. It literally made me question everything. My trading, my psychology, even if trading was real. Turns out it wasn't me. It was my understanding of liquidity. And in this video, I'm going to walk you through the entire process of what liquidity is, how institutions use liquidity to trap traders like us, and how you can reverse engineer the algorithm to trade with it, not against it. So let's go. Firstly, let's kill the fluff. Liquidity isn't a mythical concept. It's simply resting orders. Think about it. Every time you or a trader enters a position, what are we leaving behind? Stop losses, break-evens, buy limits, sell limits. Every time we're entering positions, we're leaving limit orders and other positions behind in the market. So now let's think about it realistically. Liquidity is just an accumulation of orders in one specific area. So every time you enter a position, let's say you see a fair value gap, you see a breaker structure and you go short, you're going to put your stop losses above the key highs. That means every single person who has shorted this market is going to put their stop losses right above the high. What is price then going to want to target? All of these orders in order for it to move in the opposite direction. Think about it on another scale. Let's say you're somebody who trades chart patterns. Let's say you like to trade trend lines. When you have a trend line, what happens? If I can draw it properly, when you have a trend line, what happens? Underneath this trend line, every single time a trader is opening a position, they are putting their stop losses just below. This means that below all of these lows, there is a bunch of liquidity that is sat underneath in this market. And when you stop and look at the markets and you really dive deep to try and understand what's going on, what you'll start to see is even in this just piece of price action, we can see that right here we've got this low, which can also be in terms of a trend line. So we've got a bounce off of this trend line. We've got a low in terms of market structure because this is our high, this is our higher low, and we've got a higher high. What happens when price then comes down and sweeps below this low? It immediately reverses. Why does it do that? Because right below this low, we had all of this liquidity from this trend line, from this low, from this market structure. So every single time there is a high or a low in the market, whether that be support and resistance, whether that be double bottoms, double tops, whatever you can imagine when it comes to the market where a trader is likely to enter a position, there will be liquidity resting above or below it. It's not magic, it's just the way price is engineered in the market. So if you've ever entered a position, let's say this position right here where we've just had this market structure shift, prices shifted from bullish to now bearish. If you've ever been in a position where you've then entered into the market, placed your stop just above the high, and then you've been wicked out exactly the same as this, only for price to then reverse and go in the intended direction anyway. And now you're sitting there asking why the market hates you. But it doesn't. The market just needs your liquidity to fuel bigger moves in the market. The banks, funds, and algos can't enter with $500 million in size unless there's volume on the other side. And where is that volume? Exactly where retail traders like me and you are placing our stop losses. Areas of support and resistance, areas of key market structure. Let me just quickly walk you through the mechanics of exactly how liquidity works. So let's say we're in an uptrend and we're creating a series of higher highs and higher lows. Every time there's a breakout, retail traders are getting into buy positions on this breakout. Now, you're going to always have people on the opposite direction that are trying to sell off of fair value gaps, off of order blocks and stuff like that. So all of these sellers right here are getting stopped out as soon as the breakout happens, and then the buyers are in this position. The sellers have been taken out because they have their stop loss just above this high. So let's keep it going, right? We have a nice high low coming down. This is where the smart money traders are getting in with their fair value gaps that we've got right here. But what we don't see is that right above this high now, we've got a bunch of liquidity. Why do we have a bunch of liquidity? Well, the retail traders who are now going to be looking to buy this breakout have just now taken a buy position as we get that breakout. Not only that, but early sellers who have again been trying to sell off of this fair value gap, sell off of this order block, have now got their stop losses just above this high. So now the same sellers who have their stop losses just above this high will also have a buy stop on the opposite side because they want to be in the market at all times, right? So what have we got above this key high in the market? We've got a bunch of buy orders, buy stops. We've got a bunch of stop orders, stop limits, stop losses. We've got a bunch of orders sat right above this high. So what happens when price goes and breaks above this high when you're expecting it to continue with that bullish trend? Well, what you didn't realize is that this was yesterday's high, which means that everybody who was shorting this market yesterday has now put their stop losses above this high as well. So that means that there is so much liquidity sat above this high that as soon as we go ahead and breach that high, instead of price giving us a brand new higher high, we take a sweep of that liquidity. The big institutions enter their positions, they fill their sell positions against all of that retail liquidity, and then what happens? Price reverses. Takes out everybody who was trying to sell, takes out everybody who was trying to buy, all because everybody had their stop losses, they had their orders just above that high right there. Now, the sweep was never random. It was deliberate and it was planned. Now, let's really get tactical with this. You don't want to react every time there's a sweep of liquidity in the market. You want to anticipate it, and here's exactly how I do it. So for this example, I'm going to be breaking down this trade that we actually took inside the VIP group. And as you can see right here, I set this as a sell limit, and then we actually hit take profit. So everyone inside of the group was able to take this trade with me. So we're going to use this as an example because it perfectly shows us what I mean by liquidity. So let's get rid of all of these drawings that are on the chart and let's replay just a little bit. And right here, what do we see? Well, there's a few components when it comes to trading the way that I do. Now, I personally like to use the Asian session range, which is right here, as another pool of liquidity. Now, overnight, the Asia session usually consolidates. Now, this consolidation can lead to liquidity being built up because above the Asian high, there's a bunch of orders from people that were trying to sell overnight from support areas, fair value gaps, order blocks, resistance levels. So there's a bunch of orders that have been accumulated overnight. Not only that, but right below the Asia session, we have the exact same thing. People that were buying overnight have now got their stop losses just below the low. All of these areas at the support and resistance level, everyone will have their stop losses under that low. So there's a bunch of orders that are sat below the low and below the high. And what this means is when the London session opens, we have an influx of orders into the market. Everything gets flooded and we have a bunch of volatility that enters the market. With this volatility, price usually likes to target key areas of interest, that is liquidity, so that it can get rid of this liquidity and use it as a catalyst to go in the intended direction. Now, this is where we really have to understand market structure coupled with liquidity to really figure out in which direction the market wants to go. But for this lesson, let's keep it nice and simple because we can always expand on the knowledge that we're starting to accumulate. So first and foremost, what I like to do is identify my key areas in the market, which is the Asian range high and the Asian range low. Now, for me, the Asia session range high and low is indicated by the market structure that is created between the times of midnight and 7 a.m. UK time. So I mark that out and then I move on to the next step. And the next step is to simply follow structure. Now, as we can see, price is creating a series of higher highs and higher lows. We have a brand new higher high, then we have a higher low, and then we have a higher high. So because we're in an uptrend and we're creating bullish structure, what we need to do is we need to wait for price to give us a market structure shift. So what we can see already is that price has not only swept this first pool of liquidity, which is our Asia range high. So once we've swept that range high, what we can now intend is that the market is looking to go lower because it's taken out this liquidity pool. But before we can enter into any positions, we also have to understand where the remainder of the liquidity lies. Well, like I said, there's always going to be liquidity above key highs and key lows. So what we can see right here is that above this high, we've got a bunch of orders from early sellers into the market. So if we drop down to the 1 minute time frame, what we can see is that the 1 minute time frame has now had a market structure shift already. So what price has done is it's induced all of these early sellers into the market. And once they've entered their positions, what have they done? They've put their stop losses above this high. That means right above this high, we've got a bunch of orders in the form of stop losses. Not only that, but the same people that have put the stop losses there will also have buy stops, so that if price does reverse and it takes them out, they can get back into the market and continue with the bullish trend, right? So now we've got a bunch of orders that is sat right above this key high in the form of stop losses, buy stops, and all of that good stuff. So what that means is when we go up to the 5-minute, we are not going to be instantly looking to jump into this market. What we're going to do is we're going to wait for price to come and sweep that liquidity first before giving us that market structure shift. So if I now play price on, what we can see is that price comes down just a little bit. And instead of giving us a market structure shift, what does price do? And this is where you have to really understand the characteristics that price is showing you. Right here, price swept the low. So what did it do? It took out all of the orders that were sitting right below this low. Why would you do that? Because there's going to be buyers in this market that have entered their positions because it's bullish, right? Market structure is bullish. It's creating a series of high lows and high highs. So early buyers that have got into this market will have their stop loss just below the low, which means below this low, we've got a bunch of stop losses. And again, sell stops from all of these people that have shorted the market. So now price has come down and taken out all of the liquidity that was sat below this low. And then what does it do? It hasn't given us a market structure shift yet. So me and you, the smart traders, we're staying out of this position. We're waiting to see how price reacts, and we need a confirmation that the liquidity sweeps have happened, and we are now moving to a more floor state. So let's play price on, and what we can see is that price comes and it perfectly sweeps the liquidity that was set above the high. Everyone who had their stop losses above this high has now just been liquidated. Everybody who had buy stops above this high has now been entered. And what has happened to these people? Price has taken them out too. So not only did price come and take out the early buyers, but it also took out the early sellers. So now that all of that has happened, now price has indicated to us that it wants to finally go lower after taking everybody out. And it shows this to us by giving us a validated market structure shift. A wick is not a valid structure. A wick is just a sweep of liquidity. Valid structure is when you have a body closure below the low. This shows us that price has now shifted from bullish to bearish. So now that we've got that market structure shift, it comes the easy part. We now drop down to our entry time frame, and for me that was the 1 minute. And once we come to the 1 minute time frame, we simply just identify the fair value gap, which gave us that market structure shift. And we've got a beautiful one right here, which led to that market structure shift being closed by a body candle. So we simply take our entry at the open of that fair value gap with our stops just above that high right there. And we can be safe in our brains that we're not going to get stopped out because the liquidity sweep has already happened. So because the liquidity sweep has already happened, we can now rest assured that this trade is potentially going to pay out in our favor more often than not. And then we can target the opposing liquidity, which for me is going to be the Asia lows. Like I said, remember, there's always going to be liquidity above and below the Asia session range. So if we've taken out the high, we've still got all of the liquidity below the Asia range low. So we can always target that whenever we get into positions. So this gives us a nice 1 to 2 risk to reward. And all we've simply done is understood the characteristics that price has shown us: liquidity and market structure. So once we've done all of that, we simply just play price on, we get tapped in, and it runs straight to our take profit. I know it did chop around for a while right here, but we are patient traders. Once we execute a position, we've already assumed that risk. Once we assume the risk, we've entered that trade with the understanding there's either going to be a win or a loss. Nothing in between. We don't tamper with the trade whilst it's in action because we've already assumed the risk before we got into the position in the first place. So we've done all the hard work, we've understood what price is telling us, and we've now executed and hit our take profit. So here's your takeaway. If you keep getting wicked out of perfect setups, and if price keeps faking you out before going in your intended direction anyway, you're not unlucky, you just haven't mastered liquidity yet. Study where the orders sit, wait for the sweeps, enter with confidence, and this is exactly how I built my 7-figure portfolio. This is how I help my students pass their funded account challenges consistently. And this is also how you flip from a retail trader to an absolute sniper that knows exactly what's happening in the markets. Now, if you want more breakdowns like this in real time, join my completely free Telegram by clicking that link down in the description, because I post a whole bunch of value in there with my analysis, daily signals, and a bunch of stuff that I feel like you would really, really enjoy. And if you're ready to build a system that's not based on hope, hype, and indicators, then click that link down in the description. Book your Gemini strategy trading call, and on that call, we're going to audit your trading from A to Z. We're going to figure out all of the blind spots, and we're going to put together a plan so that you can turn into that elite trader that you've always wanted to become, who's consistently able to withdraw profits from the market. So that's pretty much going to wrap it up for this video. I hope you guys enjoyed it. And if you did, don't forget to leave a like, comment, and subscribe. But on that note, I'll catch you guys in the next video.